So I think there are no exceptional results per se, but then there's not been any major disappointment also. So I think if we see the IT companies, most of them reported slightly better than expectations and have indicated better growth. So I think that's what has stabilized most of those stocks, the large cap ones at least. And on the mid cap side, some companies have done better. On the banks, the good thing is that asset quality has held up very well. Now, in these results, one thing is which is affecting is that these extraordinary write-offs which all companies have to do due to the new labor code. So I think that's distorting all the results, and so that's why you need to decipher it with and without that. And so I think that's where we are. So major sectors to report are financials and IT as of now. So I think from the auto pack or the capex oriented pack, we still need to get the results which will come out this and next week.
Sure, so that's going to be important to watch out for. The other bit that I want to highlight this morning is Havells India. Mixed set of numbers coming in because the revenue has beat estimates, strong set of numbers on the revenue front, but the net profit has taken a little bit of a cut and it's lower than the street estimates. On the flip side, the margin expansion has been well. It's 9.2% compared to 8.7% on a year-on-year basis. So that looks good. And why I'm highlighting this is because just this morning, we're also getting news from Bajaj Electricals that they're foraying into the wires and cable segment. Recently, you've had the Adanis and Birlas who forayed into the wires and cable segment. So this is going to be a very interesting space to watch out for. Sandeep, is it going to be a fast stretch if I say wires and cables is going to be the next paints, the kind of competition that we saw there?
So the competitive intensity will increase substantially, but it might not go the paints way, because in paints there were just 2-3 major players. So one big player coming and taking market share affected that sector more. Wires and cables is more diverse, so each company, the biggest company also will not have such a large market share which an Asian Paints would have. So there will be an effect, the effect will be lower. So, but I think given that Ultratech is coming out with a huge capacity, so when they start off, I think they will definitely take market share away from some of these bigger companies. But the growth has been very, very strong, and it's very intriguing that this is wires and cables is one which has been continuously growing aggressively, while most of the other consumer products and anything, even you see anything else which goes into the construction segment or where these products would be going in is not growing as much. So it's very that this one sector just stands out.
Cement hasn't grown as much as well.
Yeah, cement hasn't grown. If you go into let's say if they are going into real estate projects or infra, so cement has not grown, or maybe sanitary ware products, if you see for real estate product, they haven't grown. Tiles are not growing. So I don't know what explains this.
And this is despite the fact that the commodity inflation is there, copper prices are going up. Still we're seeing that kind of growth coming into the cables and wires segment.
Yeah, because copper generally is a pass-through. So I think that pass-through happens on the.
But basically, I think the point he's trying to make is customers are willing to accept that kind of higher price. So
because these will be possibly going into segments where you have to put cables and wires.
Absolutely.
So if you don't put, then the projects won't move forward.
That's correct. And what's your take with regard to room AC, therefore? Because it's one of those products which is linked to cables and wires, but at the same time is price sensitive. So all of the GST rate cuts that have been undertaken, some of that will reverse very, very quickly come the summer. You believe that there will still be strong demand, and when you see demand to bounce back, this has been a story which we've been seeing for the last year. We're waiting for that bounce back to happen. It's not happened. And could it be a potential opportunity?
So air conditioner segment had 1.5 years of very strong growth. Then this year was expected, last season was expected to be good, but then the monsoons were so strong and extended that they just, and the summers were very benign. So they lost the entire opportunity. Now there is inventory in the system. So that inventory in the system will impact the primary demand from the companies to the market. So I think that impact will be there. Now it depends on how the summer plays out.
Right.
So there is some forecast of El Nino, etc., which indicates a most severe summer this time. So if that happens, that demand could pick up. But I think it's wait and watch.
Okay, Rabinder also here with the brokerages on what the views with regard to a Havells are. Rabinder, what are brokerages saying?
Well, yes, Havells reported a mixed set of number in Q3 FY26, where companies' revenue saw an uptick of 14.3% year-on-year basis at rupees 5,588 crore as compared to estimate of 5,385 crore, and healthy this growth is aided by the cables and wire business growth. And if we talk about the net profit also saw a good uptick of 8% year-on-year basis, and overall consumption trend remained modest. However, festive season saw an uptick in the demand, and except lighting and fiction and Lloyd, all other segments reported a strong strong growth in Q3 FY26, and Lloyd performance was muted with continued impact of weak summer, although channel inventory is gradually improving, and lighting revenue impacted with shift in festive season. And management in the con call remain optimistic about a gradual demand recovery, but is cognizant of industry headwind like commodity inflation. And management also said that the FY27 capex will be 1,000 crore, and Havells India capex for the first 9 months of FY26 was approximately 1,200 crore, and company is implementing calibrated price hike and enhancing operational efficiency to manage these cost increases. And after this result, brokerages has come out with the note where Morgan Stanley has maintained their neutral rating with target price of rupees 1,590 on Havells India, and Citi has maintained their neutral rating with target price of rupees 1,600. They say that they believe cables and wire margin had tailwind from the inventory gain, and some segment are aiding in driving higher growth, and overall EPS growth is not accelerating due to weakness in other segment and adverse mix and investment in talent, etc. Goldman has maintained the buy rating and high target price rupees 1,880 as compared to earlier target price rupees 1,730. And lastly, Morgan Stanley has maintained the equal weight rating and cut target price to rupees 1,532 as compared to earlier target price rupees 1,660.
Okay, thank you so much for that, Rabinder. That's of course Havells. Some of these tire stocks also, Sandeep, are in focus. Yet numbers were quite strong, as you can see visibly. You believe that some of these numbers are sustainable? Is it a structural inflection point, if I can call it that?
I think tire companies should do well because raw material prices are benign for that sector at least. So while many companies who have metals as inputs are facing pressures on the input cost, tire and crude-based derivative, rubber and crude-based derivative prices still are subdued. So these companies are benefiting because of that. And the GST rate cut actually gave a big fillip to the demand. So I think the replacement demand also picked up, and as a result, the margins are higher for many of these companies. And if we look at the commentary coming from many of the CV companies also, they are also indicating a demand uptick, so which should be good for tire companies. So I think tires as a segment should do well.
What about wires and cables? Polycab, KEI on charts, are they looking interesting at all? And I ask you this question because viewers, something to contextualize. Some of the target prices on a Polycab and the like are like 9,000 rupees plus. So you've seen very, very sharp increases in terms of how at least analysts are viewing these. And of course, Sandeep also suggested that demand has remained strong. Well, it's a bit of an enigma as to why that is so, but it has remained strong. That is the reality. How do they look on charts?
Yeah, in fact, even on the prices, you hardly see a point where stocks get beaten down by 20-30% and they see a V-shaped recovery. You look at KEI, you look at Polycab and such other names. I think there have been multiple times over the last 2-3 years that these stocks have gone through a very swift, a very quick 20% correction. And to try and counter that, these stocks have gone through a V-shaped recovery almost every time these stocks have gone through. So that becomes like an opportunity for longer term investors to try and chip in. I think Polycab has gone through a very similar kind of a correction, maybe a 10 to 12% correction in the recent past. The stock had come down towards 7,000-ish odd zone, formed a near-term bottom, a double bottom of sorts for the stock. And I think yesterday we saw the stock showing the first signs of a bounce back over here. So if we expect a very similar kind of a behavior like what the stock has shown over the last 2-3 years or so, we can expect that these stocks could try and make a comeback. And even on a relative basis, KEI, Polycab, etc., these stocks are trading far above their longer-term moving averages, and they've been far more stable, less volatile as such, with respect to many of the other sectors, which have gone through a 20%, 30% correction. Try and make a comparison 2024 highs for many of these names, and these stocks are just off by a margin of 10% to 15% so far. So I think when you look at this on a relative basis as well as on a RSI basis, these stocks look far more stronger.
Okay, so that.
Welcome back, and shifting focus back to the lenders. You had Tata Capital, which came out with numbers. The growth was impressive, but understandable, because when you're looking at NII, it will receive positive tailwind on the back of the rate cuts that have played out, and Tata Capital likely benefiting from that. 21% growth, of course, but you look at it even from a QOQ perspective. It's a very, very strong 10% QOQ growth in NII, which is net interest income. Impairments largely flat on a sequential basis, no real change there, 10 basis point reduction in cost. Growth also coming in decently well for a Tata Capital, 20% plus in terms of the AUM growth. So you're seeing a decent tailwind where Tata Capital's numbers are concerned. Sandip, let me come to you with regard to some of the lenders, and maybe 2-3 questions here. I'll come to NBFCs in just a moment. Let's talk about the banks first. The HDFC, ICICI, both having their individual sets of concerns. LDR in HDFC, they've guided for 85 to 90. When I'm running the math on an Excel file, it's looking close to impossible to do 85. 90 is a stretch. Do you believe that this is a very, very real challenge, this deposit growth garnering, which banks are unable to do? And there are a lot of banks, including the likes of a PNB, which are not able to garner deposits while loan growth is quite strong.
Yeah, so I think that's a big issue, and that's because of the liquidity in the system, because of foreign fund outflows. So whatever RBI is doing on the liquidity front, that gets neutralized because the FI outflows are so high. And combined with the trade deficit, it continuously sucks out liquidity from the system, and that's a bigger challenge. Now that challenge will be bigger for PSU banks, in my view, in the future than private sector banks. As we've discussed earlier, the younger generation gravitates more towards the private sector banks. Like you rightly said, HDFC Bank, if they are guiding for growth higher than the market growth, and on top of that they are saying that LDR will come to 85-90%, it's an impossible thing. It's not going to happen. So I think one of these things will miss the target. Either the LDR will miss the target or the growth will miss the target.
Correct. And NBFCs, would that be at all on your list of stocks for 2026 to keep an eye out on?
Yeah, NBFCs are doing well. Most of the NBFCs have controlled the NPA accretion, so that's a positive. In a reducing interest rate cycle or easy monetary policy cycle, typically NBFCs will outperform banks, and that's what we've seen last year also, and which should continue this year also.
Your favorites within NBFCs?
In NBFCs, we hold L&T Finance, we hold Mahindra Finance, and we hold Manappuram, which I think could be a potential turnaround target. Sure. But I think these are just 3, but I would think that many others could also do well.
Okay, so that's on the lenders and some of the NBFCs, but let's shift focus and talk about the QSR space. Remember, of late, this space has been in focus on the back of that Devyani and Sapphire merger that we've seen. But the other stock to watch out for today is going to be Restaurant Brands Asia. That's the operator of Burger King in India and Indonesia, because sources to agencies suggest that private equity firm Everstone is all set to sell their entire 11.26% stake in RBA. So that is going to be important to watch out for. This is going to be happening via their investment vehicle QSR Asia Pte Limited. And also we understand from these sources that RBA is expecting a new strategic investor to come in as Everstone exits. This deal is expected to be announced today. Just to put into context what these numbers could mean, the total outstanding shares for Restaurant Brands is about 58 crores, total market cap about 3,895 crores. So an 11.26% stake could mean a deal that could be valued around 440 crore rupees. What we also understand is that the new incoming investor could be the family office of the founders of India's Ajanta Pharma, and they may invest up to 800 crore rupees. So that is positive if this actually actually ends up happening. But these are just news that we're getting from agency who are getting it from their sources. Just to put it into context, Ajanta Pharma family office promoters, they run Chinese Wok, that was Wok Express earlier, and they also run Big Bowl under the Lennox's Food Works. So this is going to be a crucial investment if at all it ends up happening. But yes, we're expecting to see a block deal on this front. Sandeep, your take on how we're seeing news developing in the QSR space, a space that had been absolutely silent for the longest time. And this year, within a span of the first 20 days of the year, we've seen a big merger with Sapphire and Devyani, and now this change of guard almost in terms of shareholding at RBA. Your take here?
So I think the QSR space was supposed to be a high growth segment, but I think subdued consumer demand has led to very slow demand across the board for most of these formats over the last 2-3 years, and that's created stress on the balance sheet. So I think that was the main reason for the merger of Devyani and Sapphire, because standalone they were continuously making losses. So I think if there's some uptick in consumer demand and they can cut some costs, so maybe they'll do better. Now, on this deal, I think it will be more specific to what the P they might be holding for a long time. The fund might be have to exit, or the reasons are very difficult to predict. But the revival somehow on the consumer demand is lagging behind what should ideally have happened after the income tax relief, the GST cuts, and the benign monetary policy. So very tough to find a reason why there is no uptick in consumer demand. Maybe it's to do with high inflation of the previous years, which is still impacting consumers.
Sandeep, if you look at Everstone's exit, 23 they exited at 120 rupees. 24 that was around 25% the exit that happened, and then 2 to 3% happened in 2024 at 113, and now at 66 rupees. So they are exiting at whatever price they are getting, which also gives an indication about the kind of stress that this segment is having, and the growth which is not coming through actually.
Yeah, so there could be various reasons why PE funds exit. Maybe the fund is coming to an end, and they exited the earlier percentage, and this might be a small percentage for them. So the reasons are tough to decipher, but the stocks obviously have fallen a lot. Now it's a question of whether consumer demand revives in this segment and these companies come back. So I think that will decide how they'll do. Just because they are selling, that doesn't mean that it's a negative.
Do you see a good consolidation happening in the QSR space? We already saw one big one, block with Devyani and others. This one is also going to bring in some kind of consolidation?
Oh, it's just some investor selling, so the company operates the way it was.
Because you're talking about Ajanta Pharma family office also getting into, and they also run some kind of QSR.
But I think that will be a relative smaller piece. This is a much bigger company. So who buys, let's see who buys and what their strategy is for it.